Hello and welcome. You are joining us live once again on the Investor Lab on this special Thursday, the day before Good Friday. I'm back in our regular haunt. So hopefully with less technical issues, but unfortunately with less elephants. Gabby, how are you?
I'm well. Here's a question for you. Is today technically Good Thursday?
Well, I think it is a good Thursday.
Or is every Thursday a good Thursday?
Every Thursday is a good. Every day is a good day. It's just that tomorrow you spilled your coffee.
I did on my keyboard.
Well, lucky it's a good Thursday.
It's a good Thursday.
Good day to spill coffee on your keyboard. Do you need me to get you? Do you need me to get you something?
I'm good.
Hey, Auntie, good to see you.
You can chat.
I can get you something. Gabby's got a break.
I'll come back.
All right, fine.
I'll give you 30 seconds.
All right, fine. Jesus, I know. Now I need to waffle on my own. Okay, now I've been abandoned by the people's champ, Gabby Billing. So I'm excited to get stuck into things today. Auntie, good to see you. Thanks for joining us on this surprise Thursday event. How are you? Let me know in the chat. If you are here live, let us know. But I expect we're going to have a few less people here live this time around because we are doing it on a Thursday, which is a little bit out of sync. But of course, we are doing that because of Easter. And there is so much for us to unpack today. I don't know how long today's episode is going to go for, Gabby.
Approximately 102 minutes.
Okay, I think it's potentially going to be longer than that because there's so much to unpack right now. And I want to start by let's start with a little bit of a setup, right? So what we're going to be talking about today is basically how to make sense of the current environment and investing in the current environment. And this is not going to be last episode we talked about the fear tax a lot. This is not the fear tax 2.0. This is not like us kind of trying to bang the drum of like why you should invest because it's costing you money if you don't invest, all that kind of stuff. We actually want to take a different angle on this, and let's talk about what's happening right now. Let's see if we can make sense, help everyone make sense of it all. And I want to call myself out for something on the last episode. So it was brought to my attention that perhaps my approach or message didn't land in the way that I had intended it to, and may have come across as not being empathetic enough to people's real lived experience. And if that is how you heard me on the last episode, then for that I apologize because that's not my intent. Certainly, I do still passionately hold the opinion that the proliferation of social media and mainstream media has elevated people into a heightened sense of panic. It's elevated everyone's emotions, and I stand by that.
Yep.
That being said, when you are living, when your lived experience is that fuel prices doubled in some areas, interest rates have gone up, mortgage payments have gone up. When you see people going to the fuel pumps with tanks on their trailers, filling stuff up, it can feel a little apocalyptic. It's very hard. All of these inputs can make you feel like there is something majorly wrong. And that is a completely rational feeling to have. And if I diminished that in some way on the last episode, then I apologize. That being said, panicked people acting panicked does not mean there's a reason to panic. And we're going to unpack a lot of the stuff on this episode as well. But just on that point, in many areas, there was a 50% surge in demand for fuel just from people stockpiling fuel. And so that's actually caused some of the, I think the music's still playing in the background, Gabby, by the way.
Is it?
Yeah, it is. Yeah. Can you shut off? I was wondering why I was having my little TISM audio thing going on. Yeah. So in some areas, that's actually why there's been an exacerbation of the kind of fuel situation that's going on. But we're jumping ahead. So Gabby, the people's champ. In fact, everybody, all the comments that I saw on YouTube and stuff last time were basically like, we want more Gabby, less Goose. So Gabby, the people's champ. What are we going to cover today? How are we going to get into this?
That's so funny. Obviously, we had technical issues last week anyway. I just wanted to point out, because we just had a little huddle between us before we started this episode, because we were defining how we want to show up in this particular environment. And I think how you and I genuinely best serve people is being able to make sense of the noise. Yep. And I think sometimes, we're not perfect, and sometimes that doesn't come across exactly how we intend it to. And so maybe last week it didn't land particularly how we wanted it to, but there's a lot there's a lot going on out there. In case you didn't know, there's a lot changing. There's a lot of inputs to be processing every day. There's a lot of people's opinions. There's a lot of emotions. Like, I'm sure if you're listening to this and you're, just an everyday Australian, I'm sure that every conversation that you're having at the moment is about like the war or fuel prices or like World War III or like something stressful, cost of living. And we're trying to, I believe we can show up and try and make sense of all of that noise for you so that it can kind of like cut through that and you can try and understand it from a more objective perspective. It's not to undermine how you're feeling, because how we're feeling and all the stress is completely valid. And it's all completely true. And exactly how you're feeling and your neighbors and everyone are feeling is completely valid. What we're trying to peel away is that some of that is influenced by things that are not necessarily entirely accurate. And so pulling apart all of the noise and trying to cut through and give you this signal in these episodes is really what we're aiming to do. And so hopefully that comes through.
Yeah. And I don't want to just be the antagonist to this, but like you're saying that the fear that people have is real because feeling is reality, right? So it's like, if you're feeling scared, that is real. We're not telling you like, but the only reason I want to challenge that slightly is because, and this is good, by the way, for us to have like, for us to kind of like push and pull on different sides of this coin. Yep. I respect the fact that people feel a certain way because of the inputs that they're subjected to. So I can respect and I can empathize and I can understand with why they feel that way. And so to that extent, I think it's okay if people feel a certain way. But I also don't subscribe to the idea that that just like the situation that people are scared of isn't necessarily wholly real. That's actually kind of like what I want to unpack here. And again, you and I, it's good for you and I to come at this from slightly different angles, right? Because my point of view, so in preparation for this episode, I've got 21 pages of notes. So we're obviously not going to get through all of that, but I've compiled 21 pages of notes, and most of that is facts, right? And the reason that I've done that is because I've been trying to make sense of it all as well. So, okay, well, like, to what extent is this real? Is Australia going to run out of fuel? Yeah. What's going, like, how do we unpack all of this? And of course, no one's got a crystal ball. But I think that a significant portion of the way people feel is not representative of the reality, right? And is my point, right? The fuel crisis isn't that bad, right? I'll just like, and again, people might get a little bit charged by that because I'm saying the fuel crisis isn't that bad. They're like, fuck you, dude. Like you're not looking at the prices on the pumps, right? And so I'm saying, no, the prices have doubled. So I get that. And so the lived experience of those fuel prices going up is real. It's very real. Of course it is real. My brother's a farmer. So everyone knows the farmers are struggling with diesel and all that kind of stuff. My parents are on a pension, and they just went away to Warrnambool to celebrate their 45th wedding anniversary. So I was talking to them about their experience with fuel and traveling and all that kind of stuff. I get it. Like that's real. Like the actual lived experience is real. But the premise of why that is happening and why people are scared needs to be unpacked to be fully understood, because it is not as significant. It is not as scary as what people think. And so I think I want to respect the way people feel, but I also don't want to validate those things because in the validation of it, we can be saying I'm not going to sit here and agree that I think Australia is going to run out of fuel. Now, subject to the fact that no one's got a crystal ball, and of course it could, right? But based on the same information that is available out there as everybody else has got, I don't have an opinion that Australia's going to run out of fuel. And so people are saying Australia's going to run out of fuel. We're not going to have food on the shelves. All of this kind of stuff. And I just think the evidence doesn't quite support that. So there is this challenging point there where the lived experience creates a certain set of inputs which are necessarily true, and therefore it's rational to feel a certain way, but actually understanding what the causation of that is should actually allow you to not feel as much fear about it, because it's almost certainly going to be transitory. Thoughts?
I hear you.
Yeah, you can disagree with me. That's fine.
No, I see where you're coming from. I think there's still going to be people listening that are like, I feel stressed, and I want to acknowledge that I feel stressed. It's more like I'm
No, I
trying to
get
just
that. I'm
acknowledge,
acknowledging
like,
that too.
yeah, I want to acknowledge people that are like, if you're feeling very stressed day to day, like that's understandable. Like
Yes.
don't get confused of like, why do I feel like this all the time? It's like, it makes sense.
Yep. I agree with that. I agree with that. I agree with that. I agree with that. Okay. Where do you want to go?
Well, I think we had beat one was about the fuel situation anyway.
Okay.
Because again, what we're trying to do is there's kind of like headline beliefs about like what's happening, or like what is causing the things that people are feeling on the ground. Part of this conversation is to try and pull back and maybe give a bit more information that maybe you're not necessarily seeing unless you're digging and doing the research yourself. And this is kind of what we've always done with this show. It's like this, most people get the headline understanding of what is happening, or like word of mouth, sharing it in the community with your friends, neighbors, whatever. We get that understanding. And that's usually the most emotional, because that's what's carrying through the headlines and on news sites and social media and whatever. And so it takes a little bit more digging to actually pull apart, like, okay, what's actually going on here? So Chris, I know you've done a lot of research into the fuel situation. Did you want to start there?
Yeah. So I think it's a good place to start, right? Because if we I'm going to take a bit of a walk, right? So try and keep up, because you could unpack it, right?
Mm-hmm.
So there's a few things. Let's start with consumer confidence, right? So if we look at the ANZ consumer confidence score, it's at the worst levels in history, like literally in history, literally since I started recording, roughly in about 1975, I think, the ANZ one. Now, that is a bellwether for how people feel. Now, what I would also point out just quickly is that also doesn't correlate with the Westpac consumer sentiment, which actually ticked up and is nowhere near. So the Westpac consumer sentiment in March 2026 actually ticked up from 90.5 points in February to 91.6 points in March. So it actually shows that, arguably improving, but broadly staying the same. Whereas the ANZ Roy Morgan consumer confidence dropped to 58.8 this week. So there's obviously a bit of a discrepancy between those two things. But the broader point is there is a consumer confidence crisis. People are feeling panicked, scared, and stressed because of a fuel crisis-like scenario, primarily. Between that and also interest rates hiking 2 times in the recent months as well, that's compounded the effect, I think. But primarily it's driven by fuel, because the main fear thought that people have is fuel is running out in Australia. Australia's going to run out of fuel supplies. Logistics are going to grind to a halt. The economy is going to grind to a halt. We're going to have COVID 2.0 or GFC 2.0 or some version of things like that. And this is a reason to panic. And even if I believe it's going to pass at some point in the future, what happens in the short term? What if I run out of food? What if I can't get to work? All of these kind of things, right? And it can feel scary. And it's funny because, like, it is, as Charles Darwin said, it's not the smartest or the fittest or the strongest that survived. It's the most adaptable. I've maybe paraphrased that a little bit, but that's basically what he said. And human beings are incredibly adaptable. And I heard recently or just in the last couple of days, that Melbourne, I think it was in Melbourne, the state government's offering free public transport to people so they can get around and get to work. And I see that as a proof point that humans are adaptable, and they'll work out how to navigate through these kind of things, and everything's like, and that's actually why we don't need to worry. Whereas other people have used that as a validation metric to say, see, look how bad it is. The government's even having to give away free public transport. And so we have this high cortisol type scenario driven primarily by a fuel crisis. And again, I think that people are miscorrelating this to other events that they've experienced in their lifetime, like things like COVID or things like GFC. And so to first understand the fuel scenario, we actually have to unpack. So Byron Katie has 4 questions. And if you don't know who Byron Katie is, you can look her up. But she's got 4 questions. And the 4 questions are, is it true? How can I absolutely know it is true? How do I feel when I have that thought? And who would I be without the thought? Broadly. And so when I hear things like Australia's about to run out of fuel, the first thing I ask is it true? And then how can I absolutely know that it is true? Now, the interesting thing about that is the media, to the best of my understanding, and yes, we do live in Thailand, and so we don't sit at home and watch the Australian news every night, but people like my parents do. So I can use them as a bit of a sense check, because they literally watch they watch the 3 or 4 different versions of the news that play out over the evening, every single evening, right? So very useful to kind of talk to them, right? And the media broadly is saying Australia's got 30 days of fuel supply. Australia's got 30 days of fuel supply. It's going to run out. It's going to run out. It's going to run out. But what they're not, so it seems like a countdown. But in fact, if you pay attention, it's not counting down to anything. But for the last, for a significant period of time, I can't remember the exact how many months, Australia has, but well and truly before the Iran situation, Australia had between 30 and 38 days of fuel supply anyway. So then the Iran situation happened and someone went, oh, did you know that Australia's only got 30 days of fuel supply? And it's like, well, that is sort of true. It's between 30 and 38 days on average at any given point in time. And it's just that they started paying attention to it after the Iran situation. And then that seemed like, oh my God, it looks like we're about to. Well, if you go back to January, it was between 30 and 38 as well, right? And there was no Iran situation and no one was panicking about that. And so then the concern is then, but if we only have 30 days of fuel supply and then we have fuel shipments that are being disrupted, does that not mean that we will run out of fuel? And that's a rational thing to think. Okay, that's a rational place to get to. But then you actually have to ask, is that true? And how can I absolutely know that is true? And so then you actually need to look at shipments. So the first thing I'll say is there is a prevailing narrative that the Strait of Hormuz is closed and therefore fuel shipments globally can't get through. And in fact, I sense checked this with you. I said, what's your understanding of the Strait of Hormuz and how many shipments are getting through? And you said like something like 90% of shipments, 90% of fuel is being restricted or through the strait or something, right?
Yeah, I think what I picked up was 90% of the shipments normally bound for Australia have been cancelled or rerouted.
Totally. It's some version of that, right? It's some version of the Strait of Hormuz is basically closed. 90% of shipments are not coming, right? That's basically the sort of like high level understanding that most people have. But the fact of the matter is only 20 to 27% of global fuel trade actually goes through the Strait of Hormuz at any given point in time. And roughly 90 to 95% of the ships have been blocked, through the Strait of Hormuz. And so what that actually translates to, so the Strait of Hormuz normally handles 20% of global seaborne oil and about 20 to 25% of global liquid natural gas. And transit dropped by 95% over this period. So 20% of global oil times 95% disruption is roughly 19% of global seaborne oil supply has been disrupted through that specific route, which means that 81% of global oil distribution is continuing through non-Hormuz routes without disruption. So let's just stop there for a second, right? 81% of global oil distribution is continuing through non-Strait of Hormuz routes anyway. So 81%, it's business as usual. Of the 19%, it doesn't mean it's being deleted, or granted, there have been a couple of ships that have been blown up or whatever, right? But most of the ships, they're either sitting in the Strait of Hormuz and waiting it out, or they've been redirected around the Cape of Good Hope, which means, yes, it does cost more money in shipping and the prices will be higher and it does delay things by 2 to 3 weeks, but it doesn't mean the fuel's not there. It just means it's been slightly delayed. Okay, so in the fact of the matter is, it doesn't mean that we've lost 19% of global fuel supplies. It just means 19% of global fuel supplies have been delayed in some fashion. But they're still there, right? They're still there. So we haven't actually lost all this fuel supply. So then you go downstream of that and then you say, okay, well, what about shipments to Australia? Because there was all this talk about shipments weren't coming to Australia, shipments weren't coming to Australia. And I looked into that and 6 tankers got cancelled. 6 out of 19 shipments. 6 out of 19 shipments in March. Just trying to QA my notes on that. The problem with having 21 pages of notes is it's hard to actually find your notes. So I believe there was 19 shipments in March. Typically, there's about 80 shipments a month coming to Australia. And here we go. So Australia receives more than 80 shipments of fuel in an average month. And the nation typically relies on about 81 tanker deliveries a month. Of those, 6 have been cancelled or deferred, all from Asian suppliers, all due to arrive after April 14th. So that's a 93% delivery rate. And then in parliamentary statements, the PM confirmed that the 6 cancelled cargoes have been more than replaced. Several cancelled shipments have already been replaced by alternative suppliers. Importers are pivoting to Texas, to Texas and Mexico. Longer supply lines, but continuous flow. And crude oil supplies in Asia are already diversifying away from the Middle East feedstock and getting stuff from Central America. Now, what's interesting about that is on the weekend, Minister Bowen confirmed that petrol reserves are at 39 days, up from 38. Now, you could argue that 38 and 39 is a rounding error, but it points to the fact that it's not going down, right? We're not actually running out of fuel supplies. And so he also, Albanese confirmed that every fuel shipment scheduled to arrive in March has landed and the 6 April cargoes have been more than replaced. So this all kind of points to the idea that we're not actually running out of fuel, right? And let me just continue to riff on this for a second. We're not actually running out of fuel. And so the primary issue of why there is, because people will say, but why have fuel prices gone up and why have some petrol stations closed down? Okay, so the petrol stations that shut down because they ran out of fuel were almost exclusively independent fuel retailers who didn't have connections to the mainline logistics of like being part of a major network like BP or something like that. And it was driven by a demand shock. And the demand shock was driven by a surge in people trying to buy fuel because they were panicking. So there was roughly in a lot of locations, there was about a 50% surge in demand. So if you're a business and you sell goods, right? So you could be a milk bar or a petrol station or whatever, you're going to keep a certain amount of stock in-house. If you suddenly get a surge of demand, 50% more demand than you expected, what's the likelihood you're going to run out of stock? Pretty high. Like, because you're not going to stock for a 50% surge of demand. You're going to be based on what you know. And so the 50% surge in demand caused by people panicking actually is what has driven most of the supply crunch, because you can actually see from the shipment data. Now, again, I will put a caveat to this that no one knows what's going to happen in the future. So if something were to change in the future that meaningfully stopped shipments arriving in Australia, then the calculus would change. But as it stands right now, based on the information and the data that we have, we can't see that is happening. So any idea that it might happen in the future is speculation at best. And what I would just say to that as well is that fuel is a commodity. And so at some price, you will always be able to buy the fuel. The fuel is still existing on planet Earth. And so even if, let's say, Taiwan or South Korea said, you know what, we're not going to ship any oil from our refineries, we're just going to hoard it all, right? There would be a price at which South Korea, for example, would sell us some oil, right? Or some fuel, refined fuel. And so what typically happens when you have these kind of logistics breakdowns is people find a way. It breaks things for a little bit, and then people work out how to innovate around it, which is exactly what's happening with the refineries in Asia, pivoting away from some of their Middle Eastern feedstocks. That's exactly what's happening with some of their oil tankers that have been trying to go through the Strait of Hormuz that are now rerouting around the Cape of Good Hope. That's exactly what's happening across the board. You also see that as well in the fact that the government yesterday implemented a 50% reduction in its fuel excise to lower prices. Like, there's all these ways that we can continue to adapt, and very few of them actually. You have to push the boat out pretty far in terms of scenario thinking to get to a place where Australia runs out of fuel, particularly when there's no current data to support that is actually happening. And if there's no current data to support that there's any actual meaningful reduction in fuel or fuel imports or fuel oil or fuel refinement in Australia, because in fact, in Australia, the refineries we've got in Australia have actually increased their output as well. If there's nothing to support the idea that we actually have a meaningful reduction in total fuel availability in Australia, then you must ask the question of, like, why is there a fuel shortage? And the only logical answer is that you can arrive at is because of the demand shock, because people panicked and started to hoard fuel. And before I shut up one more time, because I've clearly got a lot to say on this topic and all the other topics. There in the 1970s, I do want to talk about the 1970s a little bit more. In the 1970s, there was two oil crises, one in 1974 and one in 1979. The one in 1979 was actually also caused by Iran, but it was caused by the Iranian Revolution, which was taking place in Iran, which caused oil production in Iran to drop by, let me get the numbers here because I actually have them. So it dropped by 4.8 million barrels. I was hoping I had the percentage, but it didn't, right? But it dropped by a bit. It didn't completely stop, but it dropped by a fair bit. And what happened in 1979 is not so much that Iran's reduction of $4.8 million barrels of oil per day suddenly meaningfully stifled the amount of oil in the market. What happened is importers and governments and stuff like this, they started to hoard the oil because they panicked. And so what they did is they sucked all the supply out of the market and they said, no, we don't know what's going on. And they hoarded all the fuel, which created fuel shortages at the pumps, which is why, and there's a lot of stories from the US. I'm not sure what it actually was meaningfully like in Australia in a lived experience, but there was people, there's a lot of stories in the US about how people had to line up and wait at the pump because there was only there was fuel rations and stuff like that. And that was caused not so much by there being a shortage of of oil, but because the oil got hoarded by people, governments, et cetera, who were panicking, which is, again, the same kind of thing that's happened today in Australia. And I promise I'll shut up in a second, Gabby, because you are the people's champ. People want to hear from you. But the thing is as well, like people worry about what this means for things like property and all of this kind of stuff. And just one final point that I make before I shut up is this is not actually meaningfully affecting things like the property market. The property market actually just, there was like nearly a 1% growth nationally in property prices in the last month, which means that during 13 rate hikes, plus another 2 rate hikes this year, plus an oil supply crisis in inverted commas, which is, I think, fundamentally not actually real, the property market continues to march on because it's actually driven by other things. But anyway, I'll let you get back to the oil point, the fuel point.
The point I wanted to pull on actually was at the start of it, and I just want to QA this. Did you say that normally the fuel supplies sit around like 30 days anyway in Australia, and it's only just like now that it's kind of more a public number that we're paying attention to it?
Yeah, typically between 30 to 30. Let me try and search in my notes, right?
Because I find that very interesting. What comes to mind, we have a lot of business owners that listen to this podcast, right?
Yeah.
And we have a lot of business owner clients. It reminds me of like monthly cash flow. And particularly, I don't know if like employees in a business don't usually need to worry about a business's cash flow or the cash position of the business. The employees they do their role, they do the thing that they do every day, and they don't need to worry. And they kind of like trust the business and the leaders in the business to keep things running in terms of cash flow being that commodity, the resource that's moving every day. And so it sounds like, imagine you had a business that had like very short cash reserves, and then suddenly the employees find out that like, we only have 30 days left of cash in the business. And then suddenly the employees start freaking out. But really, maybe that business has operated on 30 days cash flow for like 5 years. And it's totally just how the business operates. But it's just that people are just starting to find out that number, that it's starting to bring up this panic, and it changes your behavior. And it sounds like similar to that situation. If that's true about normally we don't actually have much more than 30 days fuel on stock.
Yes, I'm still trying to QA that, but that is the best of my understanding. I think it's been at least that's been the it's been that for at least the recent history is the point. Like, so it's not like it suddenly dropped. The point is that it didn't suddenly drop because of the Iran situation. So my understanding is that it's been like that, and I'm just QAing that right now. Yeah. My understanding has been that way since roughly the start of the year, at least. But the broader point is that it wasn't caused, like Australia being at 30 to 38 days is not caused by the Iran conflict. Now, the downstream effect is if it is only 30 to 38 days and then we have a supply chain disruption, then that might mean that there's not enough fuel in store, right? So both can be true. Both can be true. It can be like, okay, so this is normal. Okay, this is normal. Okay, maybe that's not enough, right? Like, both can be true, right? So, but yeah, that's the best understanding. It's definitely it's not caused by the Iran situation. It's not caused by suddenly a deficit of fuel tankers arriving in Australia. That's the point.
Yeah, I think it's interesting. I hope this doesn't come across the wrong way. I'm just thinking through this as like it sounds like it's kind of information that maybe like everyday people weren't really meant to know. Because when people start to panic and start to hoard things, and that's what's actually causing issues.
Totally. Here we go. Right. Here we go. So Australia has operated roughly 20 to 40 days of consumption cover which is fuel supply,
Yeah.
for years. The
Yeah.
current 39 days of petrol is actually the highest it's been in about 15 years.
Wow.
So we actually have more fuel. We've got more petrol today than we've had in 15 years, right? Which is fascinating. So let me go through some historical stuff. So in 2002, the reserves peaked at 310 days. In 2002, the 2020s. In 2002, Australia had 310 days of fuel, which is obviously nearly a year. Australia had 8 operating refineries at that point. Between 2002 and the early 2020s, that dropped off significantly as Australia's refineries dropped from 8 down to about 2, or down to not about 2, there is 2. And Australia shifted from refining domestically to importing 90% refined fuel from Asian refineries. Last year, Australia met the IEA's 90-day net import requirement. 2012 was the last year that Australia met the IEA's 90-day net import requirement. It has been non-compliant every year since. So since 2012, there's been less than 90 days. They've been importing less than 90 days of fuel net imports. In 2022, post-Ukraine, the government introduced a minimum stockholding obligation, which is the MSO, to arrest the decline because there was continuously getting less and less fuel stored, i.e. that's why they haven't been meeting they haven't been IEA compliant since 2012. They haven't had 90 days of stores. In 2024, Labor increased the minimum stockholding obligations, particularly for diesel, from 20 days to 32 days. So in 2024, the minimum stockholding obligation was just 20 days, and they increased that to 32 days. In early March, so granted this is early March, Minister Bowen told Parliament stocks were at their highest levels in 15 years, 36 days of petrol. So this is early March. This is before the crisis. This is before Iran. Okay, so that all kicked off sort of mid-second week of March, right? So, and specifically this comment is from before they kicked off. So Bowen told Parliament stocks were at their highest levels in 15 years, 36 days of petrol, 34 days of diesel, 32 days of jet fuel, the highest level in years at the start of March. Now, we're at 39 days of petrol, 30 days of diesel, 30 days of jet fuel.
Interesting.
So, and again, I'll point out that this is since 2012, for over 15 years.
Yeah,
we haven't had these supplies. So this is, and to your point, like you and I know someone who has a 9-figure revenue business that has working capital in their business of 30 days at any given point in time. Right. And that's cool because it's like a kind of an old business. They've been around for like 20 or 25 years or something like that. And so they're operating
very tight.
Well, their operating model is very tight. They know exactly how much they need. They know exactly what's going to come in and go out each month. And so they're just like, well, we don't need to keep all this cash on reserve because we know exactly where the demand's coming from. And so there's
rather
no point
deploy it.
Yeah. Rather than just having cash sitting around in the business. So they just, they deploy it as significant dividends every single month or whatever, right? Yeah. So, but if everyone in that company, of which there are a lot of employees, if everyone in that company knew there was only 30 days of working capital in that business, you're right. Maybe they would have a little freak out. The point here is like, the media is grabbed hold. So there's a crisis in the Middle East.
Yeah.
The Strait of Hormuz has shut down for meaningful intensive purposes. Although what I would actually say is they are letting some cargo ships through for non-enemy nations. So countries like China, Pakistan, there are countries that are getting ships through. It's not completely blocked. It's just blocked to people they don't like. So there's that. But the media's, so there's been a situation in the Middle East. Strait of Hormuz has been broadly shut down for all intents and purposes. And the media has jumped on this bandwagon of that means Australia's going to run out of fuel. We literally have more fuel today, more petrol today than we've had in 15 years. So
I kind of know the answer, but why is fuel more expensive at the pump then?
So that is a really good point.
Because it's all well and good for us to say like, hey, actually there's more supply than ever, but people are still paying more for fuel.
Yeah, no, they are still paying more for fuel. And that would be because two things: downstream prices to the petrol companies. So the petrol companies are importing fuel from Asian refineries now, right? So 90% of fuel is coming from Asian refineries. Their raw oil supplies have been disrupted, or more specifically, the price per barrel of oil has gone up and has been priced because of a perception of disruption, right? Which is actually more important. And you can see that because overnight, Brent crude dropped below $100 for the first time in...
Did it?
Weeks. Yeah, so it dropped down to $99, right? So which it was significant. It was like 20. So what was it? What did it go up to? Went up to like 120.
120 something.
Yeah, 120 something, right? So it dropped overnight. It was down to $99.05 overnight. So part of the pricing mechanism for Brent crude oil is based on same as everything else, like fear, supply, demand, all of this kind of stuff, right?
Yeah. Sorry, I'm just looking at the spike again. I'm going to assume that Trump's address to the nation was not as positive as people were hoping it would be based on the spike.
Sure. But, yeah. We'll come back to that, right? But yeah, we'll come back to that because for those of you who are paying attention right now, the Donald Trump is addressing the. Yeah, I don't know. Let's come back to that. Let's not get distracted by that. But he's doing he's addressing he's doing an address to the nation right now. I see a headline here that says President says war is nearly over, yada, yada, yada. So anyway, but let's come back to that. So the oil refineries are buying raw Brent crude oil, right? Or crude oil, right? And so they've got to pay a price per barrel for that oil. That price per barrel is set by the companies that are exporting because there's import and export. So you've got the exporters, they're the ones, the people selling the oil are saying, hey, well, we're going to price it higher because we can because there's fear in the market and you guys are unsure if you're going to get it. You're going to want to stockpile it. There's more demand because more people are trying to stockpile fuel. There's potential disruption. All these things drive up the raw price of oil. The raw price of oil then gets transferred into the refined price of fuel. And so there's a downstream effect of genuine price change but again, it's temporary.
Yeah.
The oil price is live 24 hours a day. Right. This is not like the US stock market or the Australian stock market where it's only open from 9 to 5 or 9 to 4 or something like that. There's global trade happening on oil all the time. So the price per barrel of oil is constantly changing. And so has that fully flowed through? I don't know. The other side of the coin is that the Australian petrol companies, your BPs and all these kind of, I'm just going to say they're price gouging, right? There is no need for the prices to be that high. So I think they've jumped on the fact
the demand is there.
Yeah. They've jumped on the fact that the demand is there. And, to a certain extent, you could argue that, downstream fuel prices affect upstream fuel prices and therefore they're pricing accordingly. But there's some premium that's on top. And the reason I would say that is because, in Thailand, the price of fuel jumped by 20%. And in Australia, it's nearly doubled. And, Philippines is also experiencing a pretty grim scenario because they have been unable to secure the fuel, as I understand. I actually haven't done a lot of research on it, but I'll just comment on it briefly. My understanding is that just like I was talking about the fact that oil and fuel will be available at a certain price, right? Because that's how a free market economy works. My understanding is that the Philippines haven't been able to secure as many shipments because they've been able to negotiate as hard or whatever. So they're facing some more significant degree of fuel shortage than, say, Australia. But in Australia's case, fuel's still coming. So, I would ask then, what are we all worried about? Over to you. ...
Over to me. Jesus.
Yeah, okay. Over to you. Yeah. I mean, where do you want to go next? I mean, we've talked about fuel. We've talked about fuel for about bloody half an hour. Do you want to keep talking about fuel? Or do you want to talk about something else? Where do you want to go next?
Where do I want to go next?
Go on.
Here you go. I'm scrolling through the notes.
Well, let's. So I think it's kind of funny, right? Because everything's downstream of fuel, right?
Yeah.
Everything's downstream of fuel. And I think. Go on.
I just want to make a comment because obviously, Albo did this big dramatic address to the nation last night. That
my favorite burn was this could have been an email. I was like, that is such a good burn. This could have been an email.
Could have been an email. I mean, I'm sure everyone breathed a sigh of relief afterwards, but it was like, did you really need to do that? Anyway, but obviously part of his message in that was basically, don't take more fuel than you need and happy Easter.
Don't hog it.
Yeah. But even the commentary around don't just a gentle nudge to don't bump up demand too much, because that's kind of more the issue versus like putting in sanctions or restrictions or rationing or anything. It's like, it's kind of like that's also hinting at potentially it's a demand problem, not so much a supply problem.
Yeah.
Yeah.
Yeah, totally. All right, let's shift gears a little bit, right? So I've thought about where we can take this. So
Great.
There are a lot of people out there right now saying things like, now's the time to buy property. Remember what happened in COVID. When things like this happen, we end up with a property boom, right? And so what they're doing is they're drawing an incorrect corollary to, okay, what's the most recent example I've got? And they usually have an incentive, by the way, right, to say it's going to boom, it's going to boom, it's going to boom. Now, do I believe that the property market is going to boom? Yes. Do I believe that it's going to be that is going to be a result of the current set of circumstances? No, I don't. No, I don't. So I independently strongly believe that the property market is going to continue to grow precipitously over the subsequent years. But that is independently uncorrelated to the current set of circumstances. So what I'm not saying is, hey, look, let's just say, hey, there's a crisis, and you know what happens after a crisis? Property boom. Because that's not always true, right? That's not always true. And I think, and again, asking those Byron Katie's 4 questions, is this true? And how would I know this is true? How would I absolutely know this is true? Is very, very, very important.
Yeah.
Because if we look at, go.
I'm picking up the word that you said about like people who are talking about like there's this opportunity coming, are typically incentivized, right, in some way. I have no doubt that people are watching this and they think the same thing about us. It's like, obviously we're jumping on this podcast. We're talking about content about like, don't worry guys, property is going to continue to boom. So I understand if people approach how we talk about things with that bit of skepticism as well.
Yeah.
The reality is like we keep doing this because the underlying structure of real estate doesn't change. Like it hasn't changed. Like the fundamentals that are driving continued price growth haven't changed in this environment. And so the conversations that we keep having are, again, just trying to pull back, trying to make sense of the noise out there. But the underlying fundamentals are still pointing towards things moving in an upwards trajectory. So I just wanted to kind of like point that out because it's probably on someone's mind.
Yeah, totally. But I think, 100%. I agree with everything you said, right? And I think there's an important distinction to make, right? And that is, and what I said earlier, is that we believe that property prices are going to continue to effectively boom, right? Rise precipitously, right? But again, that is unrelated to an oil crisis, and it's not because crisis equals boom. Crisis doesn't equal boom, right? No. What we can see if we, and I'm going to go a few different directions with this, so just try and hold on to your hats, and you can try and keep me on track, right? If we take a look at this graphic, so we shared this last time. If we look at this graphic, right, what we can see here is that there's been a ton of crises that have happened over the last, 25 years, over the last 50 years, right? There's a crisis all the time. And in spite of that, in general, the property market continues to march up and to the right. What I would also highlight is that a crisis doesn't always equal a boom. Okay, so if we look at the GFC, if we can see on the screen here, the GFC did see national property price decline by a little bit before it continued to march upward and to the right. So in general, property prices are going to continue to grow because they're not fundamentally driven by the crises. Doesn't mean you can't have a short-term impact. Same thing here, Royal Commission, that kind of, was it correlated? Who knows? I don't know. 13 rate hikes, to the degree that was correlated, who knows? But the point here is not just like every time there's a crisis, there's a boom. Now, people are mistakenly drawing that conclusion because they look at things like, how do we get our faces? Oh, there we go. They look at things like COVID and they say, well, COVID feels kind of like, right now it kind of feels like COVID. It feels scary. It feels risky. It feels like all this stuff is going on. Does that mean there's going to be another property boom? And again, I do believe that property prices are going to rise precipitously, but no, I don't believe that it's related to this. So the best corollary that we've got to the current set of circumstances is the 1970s oil crisis that happened. There was two, right? So it was 1974, which was driven by OPEC sanctions against most of the Western countries, specifically the US and other countries, surrounding their opposition to the Yom Kippur War, which, that's fine. And then the second one was in 1979, which was driven by the Iranian Revolution. So there was two situations in fairly tight, tight sequence that resulted in a protracted kind of sequence of oil crises, which had a protracted impact of about 10 years. Now, what's interesting about that is if that's our best corollary, right? What are our data points? What can we look at? And when the price of oil goes up, right? Even if we don't think it's justified, right? Even if we sit here and go, look, there is no oil crisis, there is no fuel crisis, there's nothing to worry about here. It doesn't mean that prices won't go up and potentially even stay up for an elevated period of time. Because I don't know, like, what incentive do the fuel companies have to drop in prices? I don't know, right? So, and also to Josh's sort of point in here, what if imports do get disrupted in the future? We don't know, right? But at the moment, the data's not suggesting we do have an import issue. Mm-hmm. But if fuel prices go up, the downstream effect of that is the cost of goods and services goes up. So that translates as inflation. Now, the RBA has a target of 2 to 3% inflation. Mm-hmm. And they use trimmed mean. I'm just trying to get up the current trimmed mean. Where is it? They use trimmed mean inflation prices. Here we go. Import prices.
3.3%.
Yeah, I think it's 3.3. I just wanted to check if there was any later data. Q4. Okay. Yeah, it's roughly 3.3%, right? 3.3 to 3.4% trimmed mean CPI. 3.8% raw CPI. Now, CPI will be increased because of the cost of fuel. Now, that could be a cause of concern for people because that means their day-to-day living expenses are going to go up as well, right? So that's reasonable to be concerned about that. The RBA also has a mandate to manage inflation, so maximum employment, sustainable inflation, or whatever. I can't remember the exact the policy wording. And so, if inflation is going up, probabilistically, interest rates would go up. And this is exactly what happened in the 1970s. So the inflation went up and by the way, in the 1970s, the RBA wasn't independent from the government. So it was a government tool. There's lots of differences between now and the 1970s in terms of functionally how the government and the economy runs. So we can only draw so much comparison between the 1970s. But basically, interest rates went up, cost of living went up, everything went up. Inflation went up, cost of living went up, interest rates went up. Fucking crazy, right? Plus, also, what the government did is they said, okay, you know what we'll do to combat this? Because there was way more government jobs as a percentage of total labor force participation than there is now. So there's way more in the private sector and less in the government sector now. But back then, there was way more in the government sector and there was way more trade union power. So then there was a wage fixing agreement, which basically said, right, we're going to crank up wages. So wages went up by 29% over, I can't remember over what period, but basically over the period of the 1970s fuel crisis. I can't remember if it's over 5 years or 10 years, but they went up by 29%, which was a lot. Must be shorter than 10 years. They went up by 29%. It was crazy, right? So they cranked, and that was by government mandate. The government said, nah, we're driving up wages because everything's getting more expensive. So we're going to drive up wages. We're going to force wages up. And a lot of that was driven by government spending and government subsidies and government surplus as well. And then they also went on a spending spree to try and create more jobs and all of that kind of stuff. And so you had this dual competing force. Cost of living was going up, and also government spending was going up, which was flooding the market with more money, which then drives up consumer price inflation. And they were driving up wages, so people had more money to spend on the goods and services that were going up in price, which increased demand for the goods and services, which increases the price spiral upwards. So it was the stupidest possible thing. But that's actually what happens in stagflationary environments, right? Which is where you have high inflation and low growth. That often is a symptomatic outcome, where you end up with this situation where the government's trying to stimulate the economy, but in the process of trying to stimulate the economy, they're actually driving up inflation, which is choking the economy. And this is the stagflationary trap that stagflation is not good, right? And so there's a stagflationary risk with the current setup as well. And so, it's interesting. And by the way, I did an analysis, which I'll quickly share on the screen, and we will share this in the show notes. And if you're listening to this and you can't see the show notes for some reason, if you go to tools.dashdot.com.au/oil scenarios, all one word, tools.dashdot.com.au/oil scenarios. I did a deep dive analysis on, I basically overlaid the 1970s oil shock onto buying an investment property, and it was based on March's information. It's only the 2nd of April today, and I finished this just the other day. So basically, this kind of looks at like what would it look like if we overlaid those set of circumstances on the current situation in Australia, based on a set of inputs, adapted to the current set of circumstances, accommodating things there's a bear case, a base case, and a bull case. And it factors in things like CPI, monetary debasement, all kinds of different stuff. And so it also kind of maps out what happened in the 1970s. So you can see in the 1970s, Australian CPI peaked at approximately 18%, which is crazy. CPI of 18%. Interest rates climbed to 10 to 13% through the late 1970s. So all of that kind of stuff. And then we've mapped that onto Australia today. And we've created a bear case, a base case, and a bull case. And it's really interesting to kind of see how this plays out, because what happened in the 1970s is that house prices broadly, and it's a bit of mixed data. You've got to unpack capital cities versus non-capital cities. So Sydney and Melbourne, the market cap of Sydney and Melbourne is so large that whatever price movements they have adversely affect the national median house price. Same as today, right? If Sydney house prices were to drop by 10%, you would see national house prices drop by some significant number, just because of the size of the greater Sydney market cap. And so what happened in the 1970s is, if you just look at the national median house price, is it broadly sort of went sideways up a little bit, right? So you could sort of say that property roughly, drifted and went up. But actually, in real terms, it took you about 14 years to break even on property. And so you could sit there and go, oh my God, that sounds terrible, taking 14 years to break even on property in real terms. And what I mean in real terms, I mean on a purchasing power adjusted basis, right? So let's say you bought a $100,000 property, and then 10 years later it was still worth $100,000. But if the cost of living had gone up by 50%, if CPI had gone up by 50%, then the real purchasing power of that $100,000 property has gone down by 50%. Okay, so you would have had a 50% loss in that circumstance. That's not what happened, but just to kind of paint the picture. But the interesting thing about that is that you were still financially better off to have bought a property than to hold equities or cash over that period of time, because you still, yes, you did lose some value in real terms, in purchasing power in real terms, but cash completely you got decimated, and equities until the early 1980s when the Hawke Keating government basically put in a whole bunch of financial. They overhauled the financial markets, right, and opened that up. That created a spike in equities right at the end of that period. So you've sort of got to discount that a little bit, because you got to take that out. If you normalize that out, basically equities got trashed, cash got trashed, and real estate was your best bet. So similarly to today, and I'd encourage people to go and read that the analysis that I put together. Similarly, if you look at it today, like if you can sit there and say, okay, well, if we have a stagflationary event, we might not have again, I'll preface this by saying I strongly believe that we are going to see precipitous price increases in property, because we're already seeing it. And, real estate prices went up by nearly 1% nationally just in the month of March. They went up 0.7%. But assuming that that wasn't to happen, and you might say that there's going to be a stagflationary event, and therefore property prices are going to flatline or stagnate or whatever, and CPI is going to go up, and there's going to be government stimulus, which is going to debase my currency, so my real purchasing power goes down, versus also the cost of goods and services going up, and yuck, that all feels pretty bad. You could say, on the basis of that, there isn't going to be some spontaneous boom that comes off the back just because there's a crisis. And I think that's a rational position to take. I think anyone who's sitting there, any kind of talking head that is sitting there trying to claim that this is the same as COVID, and remember what happened in COVID, we had a crisis and then there was a boom. So you've got to get in now because crisis equals boom. I think that's a really short-sighted point of view to take, because different inputs, different outputs. Hey guys, good to see you guys in the chat. Thanks for joining us. Different inputs, different outputs. So if you take the point of view that we're not going to have a boom that is specifically caused by a crisis, and in fact, we may have something more like stagflation, then the rationale goes from this is a time to make a ton of money because it's going to boom, to what do I need to do to protect my money? Is actually, and it's a very different and very important conversation, because sometimes the most important thing you can do to preserve, to create wealth is to preserve it, right? So there's times where you can make a lot of money, and there's times, and by the way, that's if you believe this, right? So I don't, but I'm trying to meet people where they need to be met, right? And so my point of view is that property prices are going to go up. Fine, you don't have to believe that. But if you take a look at the analysis and you take the bear case scenario, which is a totally rational thing to do, by the way, it's totally fair. You can take the point of view that maybe this is all going to be pretty yuck for a protracted period of time, for like 5 or 10 years. Maybe we're entering into a pretty yuck kind of period economically. And if it is pretty yuck and stressful, and CPI is going to go up and interest rates are going to go up, and this is all going to, all of this kind of stuff, and monetary debasement is going to go up all at the same time, you can then ask yourself, well, should I even be investing? And I'll say it again, that sometimes the best wealth creation decision you can make is working out how to make sure you don't lose money, right? How to preserve your wealth. And the analysis that I put together, which I spent quite a lot of time on, by the way, points to the fact that buying property is the best way to preserve your capital, right? So you'll actually still end up outperforming equities and outperforming cash, even if property doesn't even perform well. Because in an environment that property doesn't perform well, because residential real estate in Australia is now both a risk on and a risk off asset, which is different to what it was in the 70s, because it was pretty much no property investors in the 70s anyway. So it was all homeowners. But now it's both a risk on and a risk off asset, which means that in an environment of high speculation, so for example, just imagine after COVID when there was all that stimulus coming in and everyone just wanted to bloody invest in everything, right? In a risk on type market, property booms. In a risk off type market, when people get scared, where does money go? Real estate. So it's both a risk on and a risk off asset. But if we just assume for the moment that it tracks everything else, and you assume that the economy is going to go to shit, and the stock market's going to go to shit, and everything's going to go to shit, and property is just going to be flatline, you're going to buy a property and it's not even going to grow in value, you might then say, well, there's no point buying property. And my position would be, you're actually still going to end up significantly better off by buying a property that does nothing than by sitting in cash, or by buying equities. And I only raise equities, so we've got a third example. And if I just reference the analysis that I put together, so and again, I would encourage people to go and check this out, because I put a ton of time, effort, and energy.
It's a really good reference. Yeah, you did well.
Yeah. So in the comparison document here, in the master comparison, if we look at the bear case, if we look at the bear case, the base case, and the bull case, and again, this is all validated by significant analysis further upstream. So we'll just have a look at the outcomes here. So in the bear case, over a 10-year period, property's real return is 60%, plus 60%. Cash is down by negative 17%, sorry. And equities would be down by negative 10%. That's adjusted for real purchasing power. So that's adjusted for monetary debasement and CPI, consumer price inflation, and all of that kind of stuff. The base case, property real return is about 119%. Cash's real return is negative 9%. And equities real return is plus 15%. So 15% positive on equities, but 119% on property. And in the bull case, which is like, all right, all this blows over pretty quickly, and we go back to Hoontown, then the property's real return. And again, this is not using Dashdot's historical averages or whatever, which would massively inflate the numbers. This is using some statistically defensible numbers. Property's real return would be 330%, cash's real return would be 0%, and equity's real return would be 59%. So the question here is like, not just, is there going to be a boom, and trying to hype people up that there's going to be some crazy boom and you've got to get in now before the boom starts. It's actually like, okay, you don't need to believe there's a boom. You could actually believe, that things are not going to go that well. And then the best question you could ask yourself is, how do you weather the storm? How do you make the best wealth decision you can for yourself and your family and your friends and all of that kind of stuff? And in an environment where everything is going to crumble and be degraded by the economic situation, the best thing you can do is work out how to preserve your capital and potentially still grow it, by the way, in real purchasing power terms. Yes, Josh, in the chat, I can paste a link, although I don't know the link will work, but if you can...
Don't multitask, Goose. I can do it.
Yeah.
I've done it already.
I've done it already. Yeah. So the point here is like, you don't need to be chasing a boom. You don't need it. No one needs to be trying to spruik like, this is going to be a boom. It's like, okay, what if it doesn't go that well? Does it still make sense? Because sitting in cash certainly doesn't. And so what are you going to do? Because every choice that you make is a wealth creation choice. Your choice to not invest is a wealth creation choice. To sit in cash, that's a choice. Doing nothing is a choice. But that choice has consequences. And so you've got to work out what's the best decision you can make. And no decision is still a decision. You were going to say a couple of things? I can hear you.
Yeah. So obviously we've titled this episode, "Should I be thinking about investing in times like these?" Right. So the concept, I think even the idea of investing generally can have two different connotations. When times are good, investing becomes like, how do I create financial freedom? How do I like maximize my wealth and like create more and more passive income? People so badly want this passive, mystical passive income. It becomes that like, how do I take what I have and maximize it?
Yeah.
But then investing is also a wealth preservation thing. And even if you don't resonate with the word wealth, it's like my resources, like it's financial security. Investing is still required in more challenging times as well. So it's like it's the same mechanism, but can just be wrapped differently in how we think about it. So like, again, if you're hearing the word investing now and you're like, I can't even conceptualize doing that, because you're thinking about like the more positive, like financial freedom and like live your best life. And you're like, that's so far from how I'm thinking right now. But it's more taking this approach of like, well, it's actually, you still invest, but you do it more so to protect your downside, to protect what you have now, because it's going to get corroded away over the next 5, 10, 15 years, however long. I think is an interesting reframe to have, because I think, again, I think people would be thinking like, I'm just investing. It's not like I'm just not going to do anything right now because I just don't know. One thing I wanted to pull on, and Josh, you kind of left a comment in here because I do think is relevant, is around like cash flow and lending.
Yeah,
because it's all well and good. It's all well and good for us to say, "Oh, I'm about to refresh my screen. Why?" Okay, no, we're good. It's all well and good for us to say prices as like one metric are going to go up, but realistically, lending is going to get harder. Cash flow is going to get tighter. People are already experiencing that with mortgage repayments and rates increasing. How do we find that balance for people when we're saying residential real estate is probably still the best asset for you, but over the next 6 months, 12 months, multiple years, either A, getting into that asset is going to be harder because of affordability and wage growth not keeping up and lending getting tighter, but then also being able to hold on to that asset to make the repayments and everything. How do you balance those two?
I think it's a very important part of the conversation. And again, because like my position on all this is I'm not trying to spruik people to just, because you're right around this like mindset of like investing, right? So in good times, a lot of people think investing is taking risks to make money, right? I'm going to just take a step back and I'll come back to the cash flow and getting into the market and borrowing capacity and all of that kind of stuff. A lot of people think that investing is taking risk to make money, but actually it's managing risk to grow capital, right? And so, or to managing risk to grow wealth, right? So one way to think about this is if the baseline is 0, right? And you can deploy capital and your capital can go up, then you've gone up from 0, right? So let's say you've gone up by, let's just pretend, right? It's like it's ground level, right? And then if your wealth goes up by 10 meters, you're 10 meters above the ground, right? So you've made a distance of 10 meters between you and the ground. So functionally, your wealth has gone up versus everything else. So it's like purchasing power, whatever you want to consider to be ground zero, right? You've gone up by 10 meters, right? 10 units of measurement. So now you're above. So you've gone up. And people think about investing as being up only, whereas actually it's the difference between the rest of the reality and your reality. So if the reality is that ground zero goes down, right?
Or it's like sloping.
And you stay, well, if you stay the same, if you go up, if you invest in a boom time, or if you invest and when everything's at ground zero and you make money and you go up by 10 meters, right? And you're up here, and then the ground goes down, but you stay the same, right? So you're only 10 meters above where the ground was, but then the ground goes down by 10 meters. You're now 20 meters above where the rest of the environment is, even though functionally you haven't increased the height of your position. Okay. And so sometimes keeping your wealth is actually making wealth relative to what the rest of the world is doing. And so it's not just about like, how do I take a risk on environment and speculate and make a bunch of cash? It's both how do you make money when the opportunity is there to make money, and how do you preserve, or how do you build wealth when the opportunity is there to build and grow wealth, and how do you preserve wealth through volatile times? And there are times that are going to be volatile, right? It's not always like investing in is a choice. Staying in cash is a choice. You don't like, it's all choices, and it's all asset allocation. That's all it is. And I think it's very important for people to reframe around that, because I think that investing is a speculative act that you do when times are good to try and make more money. Whereas actually sometimes the most important that you can do is try and protect the thing that you've got. Right. And the biggest risk is staying in cash, full stop. That's always the biggest risk. Now, sometimes you want to carry that risk. So for example, so we invest in equities as well. We haven't really done much investing in equities this year at all. Mostly we've been stockpiling cash. And I sit here all the time and say cash is trash, basically. It's constantly going down in value. Why would I, of all people, want to sit in cash? It's like, well, because I can understand the cash risk. I know what the cash risk is. And I know over what period of time the capital is going to degrade, and I can kind of like work that out. And so when there's increased volatility in something as liquid as the stock market, I'm like weighing the risk of staying in cash versus the risk of entering into the stock market in opportune timing and all of that kind of stuff. So it's all a choice. And it's all about time horizons as well. Because when you're buying property, you shouldn't be thinking about trying to make money in the next couple of months, right? You should be thinking about how you're going to make money over the next few years. And if it's all right, I just want to go off on a tangent on that, actually, because we don't know how long, and I'll come back to the cash flow affordability thing, because it's very, very, very important that we talk about.
Yep.
We don't know how long this situation is going to last. And so in the analysis that I did in the investing in an oil crisis scenario analysis that I did, I looked at a couple of different scenarios. What if this resolves quickly, or what if this is protracted for a longer period of time? By the way, no oil crisis has ever lasted more than 4 years. So that's the sort of timeline we're looking at. There's never been a major economic disruption, or let me rephrase. There's never been an oil crisis that's lasted more than 4 years. But we don't know how long this kind of thing is going to last. And there's a lot of signaling saying that from the US, particularly saying they're trying to end this quickly, because I think they got in over their skis. I'm not going to take a political point of view on this, but it appears to me from the things they've been saying and the way they've been acting over the last couple of weeks, it feels like they got over their skis. They bit off more than they can chew, and they're trying to find a way to get out of that. Now, if they were to get out of that, and if the Strait of Hormuz was to open up again, and if that was to happen in the next few weeks, we'd see this resolve pretty quickly. Consumer sentiment would likely change pretty quickly, even though the prices at the pump would probably stay elevated, and the people are going to rush back into the market. So just thinking about these things pragmatically is also important, because if you wait for the signals that everybody else waits for, so for example, if you wait for a rate cut before you make a decision to buy, you're waiting for the same signal that most people are waiting for, and then you're going to be competing in a much hotter environment, which means you're actually going to pay more for the assets. Right. So if you're entering into an environment where you're participating in a higher level of competition, almost certainly you're going to pay more for the asset. So there's a compounding effect of waiting for those signals rather than actually trying to think through beyond the short term. And to that extent, we might take a position that the Iran conflict could be resolved in the next 1 month, 3 months, 6 months, 12 months. You can pick your time horizon. But necessarily, you shouldn't be investing in real estate for any of those time horizons. You should be investing in real estate for 3 to 5 years at a minimum, maybe 10, maybe longer, right? And so then the question you would need to ask yourself is, over what time horizon am I making this decision? So for example, one of the things that we did invest in recently was some leap options in some companies. And guess what? The stock price, since we entered into those leap options in several weeks, just a few weeks ago, has gone down quite a lot. But those leap expiries are in 3 years' time. So I don't care. I literally don't care. I don't care. We didn't buy the options to expire in the next month. So I don't care. What my position is, like, where is this going to be in 3 years' time? And that's kind of why I like long-term leap options. And so thinking that through is really, really important as well, because making short-term decisions, having short-term reactions to long-term decision-making is not useful. Now, let's go back to the cash flow and borrowing capacity and all that kind of stuff, because it is very important. And this is the one caveat, right? Because currently markets are pricing in roughly 2 more interest rate rises, potentially 3 by the end of the year. So the odds are that we're going to see more interest rate rises. Okay, got it. Worst case scenario, we end up with a situation like the 70s, where interest rates go up a lot. They won't go up as much as the 70s. For a variety of reasons. Australia's more leveraged. The markets wouldn't support it, blah, 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 blah. We can unpack that if you want, but if you can just take it on face value that they won't go as high as they did in the 70s, it wouldn't work. Everything would break, right? And so they'd stop that before it happens. But let's say that they could go up higher. They could go up, like interest rates could go up another 2-3% in a worst case scenario, right? Maybe 3% might be an outside, but you get the idea. Could go up a lot. And I don't know, like interest rates are the one thing I've been very proudly right about a lot of stuff over the last 7 years. One thing that I've been consistently wrong about is interest rates. And I'll openly admit that, to the point now that I'm like, I'm not going to speculate on where I think interest rate is going to be, because that's the one thing that I've been consistently incorrect at, is being able to predict where interest rates are going to go. So fine. Okay, let's accept that I don't know that. But if I don't know that, what we can look at is what is the market pricing in? The market is pricing in the fact that there's likely to be more interest rate rises. So that's going to affect day-to-day household cash flow. It's going to affect your ability to borrow, because as interest rates go up, the serviceability buffers go up with them as well, right? And so your borrowing capacity goes down, so it gets harder to get into the market. And so if you take a point of view, so I'll restate my point of view, is I actually think this is going to resolve reasonably quickly, but who knows? It could go on for ages. But I think even if it does go on for longer than 6 months, I think the markets are going to adapt. I think that humans will adapt and move on. And I think that the property market is going to go up anyway. Fine. But even if you believe my scenario that everything's going to go well, or if you believe a different scenario that things are not going to go well, holding property is going to require you to be able to support the cash flow of that asset over a period of time. Fact.
Yeah.
Fact. And so if interest rates go up and cost of living goes up and all that kind of stuff, cash flow is a serious consideration. You do need to consider that. But you need to consider that against all of the other factors, not just in isolation. Not just, okay, so let's just say round figures, I'm going to buy a property and it'll be negative cash flow by $15,000 a year. But if interest rates go up 3 more times or 4 more times and blah, 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 what if that goes up to $18,000 a year? You know, that's a real consideration, by the way. That's a real, or let's say it goes to 20 grand a year, right? Plus, let's say that your mortgage goes up as well, and plus your cost of living goes up. Okay, that creates a triple squeeze on you. So you have to factor that in. But then you also have to factor in, okay, so what are your other options? Is your options to take the 150 grand or whatever you've got saved up to go buy a property and just sit that in cash and watch that degrade? How much will that cost you? Right. And I'm not trying to just position this purely as like, oh, well, you got to do it anyway. You actually need to weigh up the cost, the literal cost, the capital destruction, the purchasing power destruction of doing nothing. Now, that doesn't magically make more money for you to be able to handle the day-to-day expenses, but it does give you a point of reference for how you might need to think about changing things, because nobody wants to change. Everyone wants their life to be exactly as it is or better. Nobody ever wants to adapt to a scenario which might be more challenging, but necessarily sometimes we need to. And, you know, let's just say you suddenly lose your job. What would you need to do? Like, let's say you suddenly lose your job and you can't find another job for ages. What would you do? You would adapt. You would work out how to reduce your expenses. And would it feel good? Probably not. Probably not. But you would do it because you would need to do it. And so this is a situation where, as you're thinking about capital preservation or wealth preservation for you and your family, there may be some tough decisions that you need to make, uncomfortable ones about how you're going to prioritize things. And you can prioritize the short term if you want, and you can prioritize the false feeling of safety by staying in cash, which is actually a greater risk than buying, you know, well-placed residential real estate. And you have to factor all of that in. And so again, I'm not saying I'm not saying like, fuck it, don't worry about cash flow, you'll work it out. No. Realistically, if interest rates go up and CPI goes up, the cost of living is going to be worse, and it's going to be harder for you to cover the negative cash flow expenses of owning a property. Is that a reason to not buy a property? Well, if you're going to lose more money by doing nothing than by doing that, well, then you may want to make a prioritization decision. What are you going to say no to? Maybe you need to cancel that holiday. And by the way, don't misunderstand me. I'm not telling everyone to go and take all happiness and joy out of your life and just so you can go invest in property. What I am saying is you need to make pragmatic decisions. You know, like, so for those of you who don't know, and Gabby, I hope you don't mind me sharing, Gabby broke her leg, as most people would probably know. Gabby broke her leg this year, and there's a few complications going on with her leg at the moment, which means that we had travel plans, which we've now cancelled. Why have we cancelled those travel plans? Because we want to be able to prioritize Gabby's rehabilitation for her leg. Would it have been nice to go and do the travel that we wanted to do? Yeah, it would have. But actually, you know what's way more important? So it's not even a problem that we've cancelled the travel. Gabby's rehabilitation. That's a prioritization decision. And so sometimes you need to prioritize some things over other things because they are more important. And so that may mean that you need to change the brands of the food that you're buying. That may mean that you need to go to stop buying organic and start buying home brand, right? You may need to tighten the belt. You may need to think about, a side hustle. You may need to think about other stuff, because if you take a 3 to 5 to 10 year time horizon view, the effect on your wealth by being able to navigate through this is going to compound positively in a way that you're going to be much better off in the future. And it's sometimes hard to triangulate that. It's like, okay, well, yeah, but I'm not in the future yet, am I? And so why do I want to sacrifice today for the future? But that's the whole premise of investing, right? And so when times are tough, sometimes you just need to accept that times are tough and adapt. Like if you want to have a point of view that times are tough, but I want everything in my life to stay exactly the same, that's not necessarily adapting to the environment, right? That's sort of an unrealistic point of view to take. And so again, I'm cautiously talking about it, but I'm just talking candidly about this because everyone's going to receive this sort of slightly differently. But what I would say is you got to make these decisions with your eyes wide open. If pragmatically you're like, you know what? No, here's my prioritization decision. My prioritization, eyes wide open. I understand that that cash is going to sorry, I got distracted by the chat. I understand that my purchasing power of my cash is going to be destroyed. I understand that I'd be financially way better off if I continued to invest sensibly in a way that I can handle it. I understand that I'd be better off if I cut my living expenses to the extent that I can cut them, make sacrifices, do a side hustle, whatever it takes to make sure I'm progressing. I understand that would all be better, but I don't want to. I want to do something else. That's fine. As long as you're making that decision with your eyes wide open, I'm not going to judge you. I don't care. It's fine. But it's a meaningful consideration, because if you just blindly buy property, and again, this goes back to the point around understanding that your environment is going to change. If you just blindly buy a property, assuming that everything's going to be fine in the future, that and the cost of living is not going to go up, and interest rates are not going to go up, and cash flow is not going to change, and all of that kind of stuff, if you're blindly doing that, you may be caught unawares. You may be caught flat-footed, and if you can't hold the asset long enough to realize the benefit, then there's no point in buying it in the first place, right? And so pragmatically, and let me come back to the borrowing capacity thing if you want to say something as well. If you want to say something, jump in now, and I'll come back to the borrowing capacity thing.
Yeah, I think it comes down to like a sense of conviction, or like building this sense of confidence in yourself as an investor.
Yeah.
On what things are going to look like in 5 years. And I think that's where maybe a lot of people are really struggling in the current environment, because there's so much changing. Even if you factor in AI and technology, which we've been talking about for the last 12 months on the show, it's really difficult for people to grasp that sense of like what the future is going to look like. Because I think if you have that, and this I know is why you go so deep into researching stuff. It's because if you go and research and you pull the argument together and you like get that understanding into your bones, then making sacrifices, quote unquote, in the short term, you're comfortable with that because you're like, okay, but I know that we're moving in this direction. Whereas I think with a lot of people, they don't have that sense of clarity or confidence in where things are going. Bringing it back to real estate specifically, there's probably still people that are like not sure about, is everything going to crash? Like, hopefully people listening to this episode are getting clarity, but the majority of people won't listen to this podcast and are thinking like, we don't know what the property market's going to do. And so they don't want to make those short-term sacrifices for something that they may not know is coming because they haven't built that conviction. Does that make sense?
It makes total sense. I think it's a really great contribution to the discussion, by the way. Don't let me forget to come back to the borrowing capacity thing or the issue of getting in.
Yeah.
In fact, let me just quickly, it'll be quick, right? So in everything, let me go back to that, and I want to come back to your point, right? So everything I was talking about cash flow management is important. But the other thing that you've got to weigh up as you're making these decisions around how to prioritize your behavior is also what is the cost of delaying the potential of getting into property. Because if property prices continue to go up, it's not just the fact that interest rates going up are going to reduce your borrowing capacity, which will impact your ability to get into properties at a certain price, right? Because you're not going to be able to afford to buy properties at a certain price. If property prices also then go up, that compounds the effect, and your ability to get in, the door may be closed. So you might find yourself in a situation in 2 or 3 years' time where you're not able to buy a property. Let's say you've got 150 grand saved, right? And let's say that's enough to get into property at the moment, right? Based on the current serviceability ratios, debt to income ratios, interest rates, property prices, all that kind of stuff. Let's say 150 grand is what you need today to get into the market meaningfully, right? And then let's say you decide not to invest and you've got your 150 grand. And let's say cost of living goes up and all that kind of stuff, and you prioritize trying to keep your life as normal as possible, and you keep your 150 grand. You say, I'm just going to put that 150 grand over there and I'm going to save it. And I'm going to come back to property in 3 years' time once I'm comfortable that everything's calmed down. That 150 grand in 3 years' time probably won't get you into the market. So that 150 grand that you've got actually probably won't do the thing that you think you need it to do. And so the difficulty of getting in is only going to go up. And that's actually one of the biggest issues that I see in the market at the moment. Go on.
Yeah. And like we've seen that since running this business. Like when we started, what was it, 50 grand or something? Someone needed to work with us, cover all the costs, cover stamp duty, cover everything, deposit. They could get in and get a really good asset for 50 grand. And that's, I don't know what it is.
Oh, yeah, it's crazy. So, you know, as I was preparing the scenario analysis, the oil scenarios analysis, so something that people may have heard me say on this podcast before is I've talked about the lower quartile of suburb median house prices overlaid with jobs, lifestyle, and affordability, right? So that's the lower 25% of suburb median house prices where those suburbs also meet the criteria of jobs, lifestyle, and affordability. We call those an apex location, right? Now, because that's been in my mind for a very long period of time, the lower 25%. So that's what I originally wrote in this analysis. I was like, okay, so what is that? What do we consider an apex location? Lower quartile, blah 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 blah, meets all these criteria. That makes a location good. And then I just thought to myself, I was like, hang on a second, because I know what prices we're buying properties at for our clients. I was like, hang on a second, if the median house price is like, call it $1 million, and we're buying properties roughly in the sort of 500 to 700 grand price range, is that even still the lower quartile? And so I checked it, and it's not. So I've had to change that to the lower tercile. Right. So the lower tercile is the bottom third. Now, why is that interesting? Right? Because okay, who cares? That is interesting because the bottom cohort of the market is being dragged up. The top is staying roughly the same, right? Because people can't afford to spend more to buy more expensive properties. Yeah, and the bottom is being dragged. Yeah, there's more demand at the bottom, and the bottom is being dragged upwards towards the top. So the bottom half is compressing to the top. So it's no longer the bottom quarter, it's the bottom third, and that's soon going to be the bottom half, right? And that's compressing upwards. So that actually shows you that there's this like perpetual demand driving the lowest price properties up. So the floor price is going higher, and the ceiling price is not going higher, or not going up at the same rate that the bottom is going up. That's super interesting to me, right? Because that actually highlights it highlights why an apex location, as we define it, which you can have a read in the scenarios report, and that highlights why apex locations are actually so important for people to get into. Also, like fundamentally grounded in like why we're buying in these locations, because you know there's a two-sided demand funnel, there's a convergence of forces, there's a whole bunch of things that validate why this is important. It also actually reduces risk, by the way. If you're buying in a location where there is a two-sided demand funnel plus a convergence of forces that are going to drive markets up, you're actually reducing your risk. It's way less risky to buy a $500,000 property in a good location that has jobs, lifestyle, and relative local affordability than it is to buy a $1 million property in a market where mortgage stress is at a peak, right? It's just doesn't make sense. So I can't remember how we got there, actually. So I'm going to move on. I've lost my train of thought. So getting in. So getting in. One sec. So getting in is going to get harder, right? So yes. to the point that Josh in the chat raised, which was as lending tightens with all the perception of rate increases, which is what he said. That's fair. So it as lending tightens, so it's going to be harder to buy a property with rates increasing. That's fine. But if you take that 150 grand that you've got saved and put it on the shelf, you may not be able to get in 3 years' time anyway. So you've got to think about how you make those decisions, and you've got to think about what decisions you're going to make today, which brings me back to your point around sacrifice and choices and all this kind of stuff. So I don't like to use the word sacrifice. I like to use the word priority. Because necessarily, whenever you prioritize one thing over another thing, you're saying no to something and saying yes to something else, right? That's just how it works. You could say that you're sacrificing the thing that you're saying no to, but I would actually just say you're saying yes to the thing you're saying yes to, right? It's a priority decision.
Yep.
You cannot, anything that you want in life that is meaningful requires you to prioritize. If you want a great relationship, which I'm very grateful for our relationship, Gabby, because I prioritize you. You're a priority to me. Your health, happiness, our relationship, that's a priority to me. And so I choose that. Yeah, I know. I got to work on that. It's fine. But I choose our relationship over a bunch of other stuff. If you want to achieve a fitness goal, you need to choose to prioritize the actions and activities that necessitate you to get towards your fitness goal over the things that won't get you to your fitness goal. If you say that you want to be jacked and muscular, and then you don't go to the gym and you sit on the couch and eat junk food, you are prioritizing your current state, or you're prioritizing not getting, I don't want to, you're basically prioritizing being fat versus being fit, right? You're making those choices, right? And so every single thing that you want in life, requires that you make prioritization choices. And those prioritization choices are really your values in action is probably the best way to think about it, right? Our choices, the way we actually live our life, are a representation of our values. And so the decisions we all make are decisions that are like our entire life is the outcome of the decisions we make. Sometimes we don't make good ones. Sometimes we make great ones, right? And so as we think about any of this, we need to think about, what is the priority for me? Is the priority for short-term hedonism? Is the priority for long-term wealth preservation? Is the priority for spending more time with my family? Is the priority for making more money? Because even if we just think about income, right? So you might be able to get a job. Maybe someone offers you a job and they say, we're going to pay you double whatever you currently get for your job, right? But here's the rub. You can't see your family for more than 1 hour a week the entire time you have the job. You might say, look, there's no amount of money in the world that would make me take that deal. Sorry. No, I'm not going to do that. Prioritization is what that is. But you're sacrificing double the pay. No, you're just not prioritizing money over your family. Right? It's pretty simple. So we make these prioritization decisions all the time. And this is one of those circumstances when the environment dictates that we make those prioritization decisions. You can have anything you want, but you can't have everything you want. And so you get to choose, how do you want to go through this scenario? Because we all are going to experience environmental changes throughout our life. And we already have, right? So think about a time where someone broke up with you, where you weren't expecting to be broken up with, and suddenly your world got thrown into turmoil. Think about a time where you lost a job, perhaps, where that kind of like threw a spanner in the works. Think about a time when you were planning on doing something in your life, but you got injured and you couldn't do it. Like maybe you broke a leg or something like that. Think about it. Think about a time where you were supposed to go on a holiday and you missed the flight because you were late to the airport and you couldn't afford to buy another flight, so you didn't get to go on the holiday. Think about any decision that you've made that's led to a different outcome, right? And these environmental inputs, right, necessarily cause us to have different experiences, and so we get to choose how we want to navigate. Like the one constant, and so we kind of talked about this in the last episode, the one constant is there's always going to be stimuli that can cause us to feel fear and doubt and uncertainty and all of this kind of stuff, right? I was actually talking to a guy I know. He works in the capital markets in Australia. So he's like, does lots of like M&A funding and all of that kind of stuff, and, capital raising and yada, yada, yada. And I said to him, I spoke to him on Monday actually, and I said, how are things for you guys? And he said, oh, you mean in capital markets? I said, yeah. He said, business as usual. I said, really? He said, yeah. Public markets, they freak out, right? So he's like, public markets, they're all crashing, whatever, it's doing whatever, because they're very volatile and emotionally driven. But private markets, which is what he works in, which is like, institutional capital and all of that kind of stuff. He's like, private markets, everyone's smart enough to realize that, or everyone's experienced enough to realize, probably a less provocative way to put that. Everyone's experienced enough to realize that there's always a headline to be worried about. So unless there's some meaningful actual impact, the capital markets is just going to continue to operate as normal. He's like, he literally verbatim said to me, every single week of the last 5 years or every single week of the last 10 years, there's always been something that you could be stressed out about. And so private markets understand that. And so it's just business as usual. And it's true, right? So we have all these situations constantly, and we get to choose how we prioritize the things that are important to us through those periods.
Yeah. Again, it comes back to that sense of conviction, I think, like in those situations. And, you know, we've had huge inquiry uptick the last couple of weeks from really experienced investors to work with Dashdot. And it's like people that have had this experience before, but they've put in the reps over the years in their career or as investors or whatever, that they've personally built this sense of confidence, able to read the market and still take action. And that, I think, yeah, it's that building that sense of conviction, because even in like the examples that you were rattling off before, Goose, about like choosing to take action towards your health because you want to improve that, or choosing to prioritize your relationship, it's like both of those things you feel confident in, like taking, again, short-term sacrifices towards, because you feel confident that at the end of the day, once you put in the effort, that outcome is going to be there waiting for you. And all you have to do is like take the steps and work towards that. And so I really want people to try to build that sense of conviction in the way that things are going to go, which I know is very difficult right now, but this is how we're going to continue to show up over the next however long we need to help to drill that sense of, here is cutting through the noise to give you that sense of conviction and confidence in what's really happening in the market, so you don't get caught up in the fogginess that can come from all the headlines and other people's opinions and noise and everything that can cloud that. And then when you're clouded, you don't take any action because you're like, I don't know if it's going to be worth it.
Yeah. I think it's really important. I think it's a really important point. Like, conviction is a muscle. You need to build it, right? You don't just have conviction. You need to develop conviction. And, you know, the opposite of conviction is doubt. And that goes back to Byron Katie's 4 questions. Is it true? Can you absolutely know that it is true? So when I think I've built a muscle that allows me to now question things very quickly. So when someone says, I don't know, when I receive a new bit of information, my first general thought is, this happens pretty algorithmically in my mind. I'm not sort of sitting down and going, okay, let me ask the 4 questions. I just kind of do this on autopilot now, where I'm like, that's really interesting. That's a really interesting piece of information, a new piece of information. How do I know it is true?
Is it true? Yeah.
Is it true? How is it true? And how can I absolutely know that it is true? And how do I feel when I believe that thought? And who would I be without that thought? And so you look at the current situation. It's very easy for people to get caught up in the hype of the current, set of circumstances with price at the pump and all of that kind of stuff, cost of living, which are, again, real things. Like, the cost of fuel has gone up, which necessarily means, based on the amount of income that you have to spend more of your income as a percentage on fuel, assuming you continue to use the same amount of fuel, which again is a prioritization decision. It's a prioritization decision. And somebody might say, but I have to drive my car to get to work, and I could get a bus, but it's going to take me an extra hour. Okay, that's a prioritization decision, because you're prioritizing ease versus price. Okay, so everyone has a choice, right? Almost everyone. There's always going to be some edge case where, I'll be proven wrong, like where someone lives in a remote location and they need to drive to get to a doctor's for medical care, and they literally can't afford they don't have much money, and they literally can't afford the fuel. There's always going to be that edge case, but that edge case would exist today as equally as it would exist tomorrow or 6 months ago, right? So there's always those edge cases. But in a general sense, most people still have a choice. And so, between input and response, and this is from Viktor Frankl, I love this one as well. Between input and response, there is a space, and in that space, we have the power to choose. And it's very, very important that we take the time to think about, okay, what is this information? How is it making me feel? How do I know if it is true? Can I validate that? That's why I research things. Like, when I'm not sure about something, that's when I go hog wild on the research, because I'm like, I don't research things that I already have conviction in, because I've already developed the muscle. I research things that I'm not sure about and I want to get clear about, so that I can understand what position I should take and why, and so that I can have a high level of conviction, right?
Yeah.
And
I'll just echo that, because like, I'm someone that has anxiety. And oftentimes, if I'm feeling anxious about something, usually the solution is actually like carve out a little bit of time actually dig into what the problem is or what I think the problem is and do research, whether that's macro or in the business or like personal thing. It's like actually dig into trying to get clarity on what this thing is that I think I'm anxious about to try and get to like the truth. So yeah, I experienced that as well.
Yep, 100%. So I feel like we might have covered enough stuff on today's episode.
I think we have. Yeah, I think we have.
Now, there's some other stuff we could talk about, but I don't think we need to talk about it. I think we've kind of like one thing I will just because we're doing this live. So I just got the summary of Trump's Iran speech. Just as a quick point, because it's relevant to all this kind of stuff. Yeah. President Donald Trump addressed the nation about the Iran war from the White House, saying again that the war he initially said would last for days is close to its end. Oil prices have risen to around $100 a barrel. I think the general message is, here we go. We're going to finish the job and we're going to finish it very fast. So the Iranian leaders, I don't even know what they're called at the moment. I don't know who's in power there at the moment. The Iranian leaders said that they would only negotiate with JD Vance, the vice president. And JD Vance has been very vocally opposed to the entire Iran war, which is super interesting because he's been very careful to never take an opposing position to Donald Trump on anything throughout the entirety of the campaign and throughout the entirety of the presidency. He's been very supportive, party line supportive. On the Iran war topic, he was vocally opposed. He was like, this is a bad idea. Straight from the get-go. He was like, this is a bad idea. Anyway, they obviously went and did it anyway. Fine. Not fine, but you get the idea. Then Iran Iran said, look, we're only going to negotiate with JD Vance. Donald Trump, I think, has realized he's bitten off more than he can chew. And I think my understanding is that he basically told JD Vance, go in there, sort it out, get us out, get this over with quickly, because fuel prices in the US have gone up. Approval ratings for Donald Trump have gone through the floor. Like, it's a shit show over there. And the midterms are coming up. He wants this resolved before the midterms. I don't have the midterms date on me, but he wants that resolved. He wants to be able to say, we went in there, we destroyed their nukes, we got out. It was short-term painful, long-term painful. Yeah, we blew up some bridges, some very nice bridges. And he wants to be able to say, look, this was a success, not we're still in a protracted war scenario. And so all of the posturing at the moment is guiding towards that. It definitely looks to me, from an observer, like he is doing everything he can to get out of there with his pride intact, so that he can say, we went in, we did what we said we were going to do, and we got out like we said we were going to do. Now it's over. Everyone's back to normal. We've created more peace on planet Earth. I know it was painful for a few weeks, but hey, that's the price of freedom or something like that, right?
Now we have peace. Wow.
Yeah, now we have less nuclear threat. The world is better, right? So it's short-term pain, necessary. And so he wants to wrap that up in a bow before he gets to the midterms. That's what I think is happening. And that's what if you look at everything over the last few days, everything is saying is like, we're going to get out of there quickly, a couple of weeks. It's going to be soon. We don't want to be in there. We've achieved all of our objectives. We have no reason to be there. We want to get out, blah, 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 blah. So it just looks to me like someone who's trying to wrap this up pretty quickly, which if that's the case, then, a lot of this will become pretty redundant pretty soon, right?
Yeah. Hopefully.
Yeah.
Hopefully this episode loses relevance within 2 weeks. No one listens again.
So I feel like this is a pretty good episode. I actually dug it. Right? I think it was pretty cool. So I did. Yeah, I did. I think it was good. I think dug it. Digged it. So if you want to check out the oil scenarios, the what happens if you buy a property into an oil crisis scenario analysis, we will put a link in the YouTube show notes description. Would it go in the other ones like Spotify and stuff like that? I don't know how that works, Gabby.
Yes.
It will go in all those places.
It'll be in the show notes everywhere.
Everywhere. You can also go to tools.dashdot.com.au/oil scenarios and check that out as well if you want to have a look at the scenario analysis I did there. But otherwise, just remember to stay calm, be happy. And if you're not sure, ask yourself, is it true? How can I absolutely know that it's true? How do I feel when I have this thought, and who would I be without this thought? And it's a very useful tool to help guide you through making better decisions. And everything's a prioritization, right? So we're not saying that everything is going to be smooth sailing from here, but what we are saying is everyone has to make choices about how they want to navigate to the other side. And that's a choice that everyone has the power to make for themselves. So anything you want to say before we wrap it up, Gabby?
No, that's all.
Okay, guys. If you've enjoyed this episode, by the way, make sure you leave us a comment on YouTube and make sure you share it with somebody. Like the video, share the video, subscribe, do all that kind of good stuff because it's helpful for us.
Just on the comments, obviously we've had a bunch of people join live, which has been awesome. If you do watch this and you have any other questions, if something comes up that you're still not really clear on, leave it as a comment on YouTube and we'll come back to you. Because again, we're doing this to try and like create clarity in all of this noise. And so if you're still feeling unclear in the noise, let us know how we can help and we'll try to clarify that for you.
And the comments are super useful. So like one of the comments we got on the last video was from Olivia Ward, you know, friend of the podcast, friend of the channel, friend of Dashdot. You know, like her comment was great because it was super insightful because she would normally, you know, she said it herself. She's like, I normally agree with your point of view, but I don't agree with you on this. And I was like, oh, that's super interesting. Okay, that prompted me to then review, okay, what am I missing? And so the comments are super useful. You don't have to agree with what we say, but constructive feedback is useful because all we want to do is we want to help as many people as possible. And if you've got feedback, you've got thoughts, you've got comments, you know, concerns, it helps us to either, if we disagree massively, we're just going to ignore you anyway. So it doesn't really matter. So there's no downside to telling us how you feel. But maybe we'll get an insight and maybe we can adapt and maybe we can provide better content that's going to help you guys to navigate through all this kind of stuff better as well. So okie dokie.
Okay.
Let's leave it there. See ya.
See ya.
Bye for now.